Okay, it seems like I'm live. Hello, everyone. Can't really see who's connecting or not, but I saw someone send a heart. So thank you for that. I'm gonna go ahead and share my screen. So for those joining, it is the first time that we're doing a webinar through YouTube directly. So please bear with me. I'll do my best to try and not mess this up. But essentially, this is what we're going to be talking about. We're here to talk about the state of the MarTech, which is really just a way of saying, let's take a closer look at what's happening in marketing technology from an M&A perspective. Why are we talking about that? And I'm jumping straight into it. I want this to be super informative. As you can see, it's just me sharing intel and insights that we've seen. But I've shared my contact details, and I would encourage anyone that's listening to reach out with any questions or if they want to continue the conversation. The main reason why we're doing this is, well, we're an M&A firm. So we do a lot of M&A deals, and we focus on helping founders in tech and software sell their business mid-market. So deal sizes that we work on are anywhere between 20 million all the way up to 200, 250 million. And we've seen a lot of activity happen in the market. We've been involved in a handful of deals throughout all of 2025. We closed an important one in Q4, which I'll be talking about by the end of the presentation. And we've noticed that you guys, founders in the space, have a lot of questions around MarTech. Questions such as, how is AI affecting my valuation? What are acquirers and investors looking for? And these are the questions that we're hoping to be able to answer throughout this session today. And that's why we're doing this webinar. Now, small disclaimer, actually quite a big one. The biggest challenge that we've had when preparing this webinar has been that we've tried to put under one concept all of marketing technologies which are very different between them and very diverse. So as you all know, MarTech is a huge ocean, and there's a lot of layers to it and sub industries and segments that behave differently. So while this is not a deep dive into each one of these layers, it is important to understand what's happening across all of them and the trends that are defining M&A activity throughout the space. So with no further ado, let's jump right into it. I'm structuring this in three sections. First one, I'm just going to give a brief overview of the market and the industry. Then we're going to be looking at valuations, which is the sexy part, and what buyers are looking for. And finally, we'll just touch on the deal that we closed as an example of everything that we're seeing. That's it. The industry. In terms of industry, you probably already know this. MarTech is still a growing industry. Now, is it growing at 200%? Not really. Does that mean that there are no companies in the MarTech space growing at 200%? No, as we said, this is a vast ocean. We're generalizing here. What we do see, if we look at the data, is that MarTech is forecasted to grow by 11% in the next 5 years. And that's in line with what we're seeing in tech in general. So to compare it with fintech, for example, fintech here, it seems like there's a big difference. It's just because the market size per se is bigger, but the growth rate that's forecasted through the next 5 years using the same methodology and the same sources is 14%. Ed tech, HR tech, we're talking about 12%. Prop tech, real estate, which we all hear about a lot, 8%. So we are in line with what we're seeing in the space in general. Now, the nuance here is that, as we're saying before, and you'll hear me repeat this throughout the webinar, there's different segments. And some segments, some technologies, such as AI-driven analytics, are growing way faster than the rest, while others, such as legacy emails, are lagging behind. So as I was saying at the beginning, what's important is to understand what's driving this growth. And these are these trends. Now, I could go ahead and jump bullet point by bullet point, but that's a bit boring. And I'm sure you guys can read the slide by yourself. So what I really like about this one is to actually look at it from perspective and look at what the big guys in the industry are saying. And I really like what Annette Frank from CX Journey says. More tools don't mean better marketing. What matters is having the right tools that work together towards strategy. This is key. Why? We come from a very fragmented industry. And I'm sure this is no secret. Just to give a very simple example, I'm hiring for an SEO role right now. And whenever I'm interviewing the candidates, I'm having to ask them about so many different tools. What do you use for your research? What do you use to optimize the content you write? What do you use for the copywriting? What do you use to track the performing? What do you use to decide what you're going to be writing next and plan the agenda? So many different tools. When how easy would it be we had just one platform that unifies all the journey within SEO? If it's out there, I don't know it yet. So please, please, please share it with me. But in general, it's a very fragmented industry. And what we are seeing is how it's consolidating. So more and more tools are working together and creating platforms. And that's where we're seeing a lot of rhythm and dynamism within the M&A space. Why? Because, and this is the other key of the quote, more tools don't mean better marketing. We're also in a moment, and I'll talk about this later on in the session, but we're in a moment, and I'm sure you also know this, in which we're seeing more and more marketing technologies being built and show up and compete against each other. But that doesn't mean they're better, and that doesn't mean that all of them are going to survive. The ones that are going to survive are the ones that are able to offer what these guys are saying. We're seeing brands use unified customer data to deliver smarter, more profitable decisions across channels. This is what we're looking for. This is what acquirers are looking for. This is what the bigger guys are looking for. This is what investors are investing in. And this is directly linked to the idea that AI and data are the new mode. And not just any other AI. It's being able to have primary sources of data that are gonna feed your workflow and that are going to show you and help you make decisions that directly impact revenue. That's the other thing that's new and that's underlying in all of these trends. We also come from a world where there's always been a little bit of a disconnect between marketing, the creative side, and sales, the revenue impact. That's changing with what we're seeing here. And better real-time data also means better decisions to impact revenue, hence more pressure on that ROI. Marketing tools need to be able to connect and present themselves as a revenue engine, not just as creative or analytical tools. So just to like wrap up this part, I want to go ahead and share one other of these quotes here that will also see come up quite a lot, and it's the idea of personalization. Uh, as Scott Brinker says, we've been talking about one-to-one personalization for decades. With AI, it's finally becoming real. I remember when I was at university, and this is almost 10 years ago. Well, we were already talking about personalization, and we've been hearing this for a while, but this is actually now really happening. And we'll see how different marketing technologies are using this to, guess what? Drive more revenue. So everything comes up together. We're talking essentially about three concepts over and over again. Act on data analytics, optimizing performance. And now on this slide is where we're trying to actually get a little bit more in detail into the different layers of the marketing tech stack. The first point that I briefly touched on in the previous slide was the idea that we come from a fragmented world in which we had tools and we're evolving towards platform. In fact, there's no like it's not a secret that we've gone from seeing Salesforce and HubSpot as CRM or CDPs to actually thinking of them as customer experience platforms. And this is what we're seeing that reflects this owning the entire funnel from data to driving ROI that's happening layer by layer. And I'm going to call out a couple of examples before we go into the actual sexy part of the webinar, which is valuations and how buyers think and what investors are looking for. A couple of examples that I really like here. The first one is the commerce and loyalty experience platforms. Just the way we call them now. It's not just a loyalty or reward platform. It's an experience platform. And it's the idea that we've gone from buy 5 coffees and get one free and fixed tiers of rewards to having solutions such as Antavo that feed or that read all of the data around the customer to personalize the rewards and make sure that you actually end up buying more because they know when and what you want to buy. Or another one that I'm sure we've all used a lot, advertising and performance marketing platforms. Guys, now it's not just about using Google Analytics to say, hey, where does my traffic come from and where do I want to miss a little bit more? You have tools such as the trade desk that will automatically put that money into the ads. They'll make that decision for you. And any tracks, for example, can track the results not just in one channel, but across multiple channels. So again, they're giving you, or it's about arming the decisions makers to make better decisions based on first party data across multiple channels that will directly impact revenue. That's why one standalone tool per se doesn't really mean anything or doesn't have the same impact as a unified ecosystem of platforms. Now, with all of it said, I've tried to rush through it a little bit because I'm sure what I've mentioned all till now isn't really new for anyone in the MarTech space. How does this actually translate into valuations and what's happening in MarTech from an M&A perspective? This is what is really important. So the first thing, public markets, not the best moment, but this is universal. Again, the market headwinds, we've seen the volatility in the market across different industries. The main reason why we're highlighting this is to align expectations. Like we talk sometimes to some founders that come to us and they're like, Salesforce really needs me. I'm going to sell for 20 times revenue. Well, Salesforce isn't trading at 20 times revenue, so I don't think they can pay you 20 times revenue. But there's also a reason beyond just like market volatility per se, why across tech in general, we're seeing kind of this decline compared to where we were at in January 2025. The race per se in innovation and AI can also be reflected in the valuation multiples that we're seeing in the public space, given that, first of all, there's more and more new technologies in the space, as we were saying before. In fact, 77% of the new products in MarTech come from AI. This means more competitive pressure on pricing. And it's not just because of competition that margins might be getting narrower. It's also because of the fact that given that first party data is so important and being able to train AI models that will make decisions for us, that's agentic AI, that also impacts margins. And if at the end of the day, if you have thinner margins, investor confidence might say, hey, let me put this a little bit on hold, or let me align valuations with something a little bit more realistic on the public market until we see where this takes us. And what's really interesting is that what we're seeing in the public market isn't exactly what we're seeing in the private M&A ecosystem or market. Why? Think about the trends that I was telling you before. We need first-party data to be able to train our models, make better marketing decisions that directly connect us to increasing revenue. This means if I'm Salesforce, I'm probably going to have to buy guys that allow me to unify this whole experience and get to the revenue data point. That's what's happening. We're seeing more and more consolidation, which essentially means activity from an acquisition perspective. Take the first example, Salesforce buying Informatica. This was in November 25. In fact, I think they're still in due diligence period. Look at the revenue multiple, 5 times. It's the highest one that we see here in the chart. The rest, unless we go back to June, the rest are around 1, 3, 3.5. And essentially, what Salesforce is doing here is they're buying a data management technology that will allow them to unify the data from multiple channels into one unique source of truth that then they can use to orchestrate all of these words that would come from the AI era, to orchestrate better customer journeys, engagement with them that drive them directly to train their agentic AI models to perform activities, send more emails that will actually convert into revenue. So it's Salesforce buying data and this first party source of data and one unique center point, if that makes sense. Same idea with Adobe buying SEMrush, for instance. Adobe, creativity tool. It was Photoshop and Illustrator when I was in university. They've been acquiring and aggregating other tools in order to develop or evolve towards that customer experience platform. And now they're buying SEMrush, which is essentially data on SEO, to be able to have more data to train their models better and help their customers not just design their branding campaigns, but actually launch campaigns online that perform well on, let's say, Google or LLMS. So over and over again, despite the different layers that we see in MarTech, see how the activity that we're seeing in M&A reflects all the trends that we were saying at the very beginning. First party data, make better decisions directly tied to revenue, and own the entire funnel. In fact, here we had a little bit of a zoom into this to that I've already shared, but given that we've already talked about it, it's essentially repeating what we've already said. The idea that we're moving from only a customer data point or a CRM to a broader enterprise data and AI platform. For instance, for Salesforce, for Adobe, same idea. It's extending the data ecosystem into SEO, competitor analysis, and search behaviors so that it helps improve out of analytics, the experience, and the Experience Cloud, pushing marketers toward a more unified stack consolidation of the tech stack for creative content, SEO, and analytics. Now, if we go back here, let's look at this, guys, which is what's really interesting also. The Salesforce, the Adobes of the world. We've seen why they're buying. We see the trends they're after. Now, who are they? And I'm going to open a parenthesis here because this is something else that we see across multiple of the deals that we work on. We always talk about the type of buyer that is going to be buying your business. And we always talk a lot about financial buyers versus strategic buyers. The examples that I've given, Salesforce, Adobe, the 5 first categories that we see here, they all fall under the strategic category. And I know we all want to sell our business for the highest multiple to a strategic buyer, but there's much more to it. First of all, strategics will in fact only start looking at your business if you're in between, at the very least, 3 million to 5 million in revenue. So if you're smaller than that, keep building or follow a different playbook. Strategics aren't really that risk. I would say adverse, but that's not the right word. Anyway, they see it as very risky when the company is too small. Plus, strategics aren't or might not always be the best option for you. And what do I mean by this? Financials are the players that are literally out there just to go and buy companies. They have the dry power and they have that budget that they need to invest in buying companies. And there have been cases, we saw one ourselves last year, where in fact the financial might outbid a strategic. Let's say if they have a portfolio company that has very good synergies with the company that they're considering acquiring. Then it kind of becomes a hybrid. They have a strategic reason to acquire that company. They might have the muscle to outbid a strategic. Plus, they're able to move faster, guys. That's also very important. If you think about it, these guys are out there to buy. The other ones have a board they need to justify and convince for them to buy the company. They're probably going to have to bring all their army of lawyers and tech people to perform the due diligence. And then we're going from 2 months of due diligence to maybe 6 or more. That's just giving out their examples. The point here is strategics are a very interesting party, an acquirer agent, to call it in a way, but financials are too. Plus, you always want to bring in both of them. Why? Because you create the process and that bidding tension for them to improve their initial offers. And I'm going to talk about this a lot before, but another reason why we're seeing more dynamism or higher multiples in private M&A transactions as compared to the public market is because process and timing are important. And that's a reflection of having both the strategics and the financials compete to acquire your company. Having said all of this, I close this very long parenthesis on the different type of behaviors and type of acquirers Just to briefly introduce with you what you're seeing here, type of acquirers, we're seeing definitely the CRMs, CDPs, the Salesforce, the HubSpot of the world that are acquiring. We've seen data, AI, and infrastructure platforms that are also very active acquirers. We've seen performance and media platforms, market automation and sales enablement platforms, commerce, SaaS, and vertical ecosystems, and then, of course, the private guys, private equity, roll-ups, aggregators, etc. And if you look at why they buy and what they look for, you'll say that it ends up saying the same over and over again. It's the idea of the trends and those three key aspects of first-party data to be able to own the entire customer journey, orchestrate better experiences that drive more revenue. And in fact, what does this mean for you as a founder? This is what this slide here answers. Across everything, yes, we've talked about the trends, we've talked about who's buying, and what are they looking for when they're evaluating a company. These are the metrics that you want to screenshot right now, because these are the metrics that you need to keep in mind as you continue to scale and build your company. Buyers are going to look at them, and investors will look at them too. And they're pretty simple. We're not reinventing the wheel here. It's essentially having your basics in order. The revenue is important. Higher ARR, higher multiple. The more revenue you have and the more recurrent that revenue is, the more expensive your company is, because you're more established, there's less risk for the buyer. So always think that at the end of the day, buyers are evaluating in terms of risk. And is it risky for me to invest my money in this technology, or will I get a return on it, financially and strategically? The other thing is the revenue growth. And revenue growth is tied many times to the net margin in what we call the rule of 40, which is right here. Rule of 40 is your EBITDA margin plus your revenue growth. Should add over 40. So imagine you're at break even, but you're growing 40% year over year. You're right at that rule of 40. Imagine your EBITDA margin is 20 and you're growing 20% year over year. You're at that rule of 40. That's essentially like the metric across all of SaaS businesses, not just MarTech. Some of the metrics that might be even more important to MarTech businesses are the ratios, LTV to CAC, to show if it's an efficient growth engine or not, or the CAC payback, to see that speed of capital recovery. If that payback is longer, of course, buyers might say, well, this might not be as interesting. Now, other metrics that are also super important, besides like the financial ones that we were just mentioning, that are what I call the basics, are this three that we see here: retention. Now, it's just as important to acquire new customers as it is to retain them. In fact, many times a metric like NRR, net revenue retention, might be a deal breaker or an incentive for an acquirer or a buyer to continue evaluating an opportunity. There are, in fact, some buyers that will not look at a company that has less than 100% NRR. Why? What does this mean? Net revenue retention, at the end of the day, is the companies that you're keeping and you're upselling to. So it shows your ability of having companies that stay with you and that buy more within your product. So it's one of the strongest multiple drivers. Another metric that is also very important that many times we don't think of is this one, customer concentration. And I'm actually going to tie this one to geographic concentration. So customer concentration, you want to make sure that none of your clients represents more than 5%, I would say, of your total revenue. Why? Because this means that if one of your clients suddenly drops, the acquirer, the investor, has just lost 5-10% of their revenues. It's super risky to have a higher concentration or a high concentration of customers. The more diversified your customer base is, the better. And this is actually specifically, or it's especially tricky for those more early stage companies where it's totally normal that you close a big client and you're very excited and they represent a big chunk of your revenue. But as you continue to evolve and grow, you want to make sure you're diversifying that client base. The other type of concentration that I mentioned that is not really here, but it is also important, is the geographic distribution of your revenues. So you probably want to have revenues in the US, or at least get close to it, That's always seen as a more secure and stable market. Maybe across Europe, Latin America, having it diversify is also a good sign of de-risking the operation for the acquirer. And I think those are the main metrics. I'm trying to think if there's another one perhaps that I should mention here. In fact, I feel like I've been talking for 25 minutes straight and I haven't seen much interaction in the chat. So let me pause here before I go into sharing a little bit more about process and pass the mic on to you. We're a very small group and I'd love to hear from you. So I don't know if there's anyone here that might want to add a metric here or ask about one of these metrics or share a story of a conversation that they might have had with an acquirer or an investor or a colleague within the space. Challenge everything that I've said so far. I'm pausing here. And I'm silent. And I'm not seeing much interaction in the chat. I'm going to give it maybe 10 more seconds to see if there's anyone that might want to jump in, say something. Not really. Okay. In that case, I'm going to continue with my monologue. But again, please, the chat is there. So if there are any comments or you want to share anything, please do. Because I'm going straight into our case study. And I would have liked for this case study to be more robust and go more into detail, since it's a very interesting example of how process and timing can drive valuation. But unfortunately, like 80% of that is under NDA. So I can't really share much details publicly in this webinar. Another reason for you guys to reach out and connect with me on LinkedIn. But essentially, Q4 of last year, we closed the acquisition of First Promoter to Springwater. So Springwater bought First Promoter. First Promoter is an affiliate platform for SaaS businesses. So the founder, Virgil, founded First Promoter in 2017 when he realized that there were a lot of affiliate solutions out there for e-commerce, but none for SaaS. And that's how First Promoter was born or originated. We engaged the founder and signed the mandate. That means that we officially took on his representation in exclusivity. Oh, I have a comment there. Okay, Carlos, I'll go back to that one. In exclusivity, and I would say it was February. Took it to market. End of Q1 of last year, it was sold in Q4 to Springwater. Springwater it would fall under the financial bucket of an acquirer that had just raised a fund to start rolling up acquisitions in the SaaS space. Springwater was for them an acquisition that secured for them a profitable product-led growth SaaS platform with very strong recurring revenues. And what we saw that was pretty interesting here is that when we got to the final round, there were 3 buyers bidding that had competitive offers. One strategic that had the highest total valuation, but not so much as competitive upfront, and 2 financials. The strategic at the end gave us a valuation that we could anchor on, that drove the final acquirer to improve their valuation. And all I'll share with you is that it was in between what we saw Adobe paid for SEMrush and Salesforce paid for Informatica. So it was a pretty good valuation multiple that was acquired only and because we were able to drive this competitive process and positioned First Promoter well for what Springwater wanted. The conclusion or the takeaway of me sharing this story very briefly, very high level, because there's not much you can share publicly of a private transaction, unfortunately, is that, as we were saying before, knowing your market is important. Knowing who is buying and why is important. Bringing the different types of acquirers to the table is important. Having your metric states is super important to tell that story. And driving a competitive process is what, at the end, ties everything together and really maximizes the outcome. And with that said, that's kind of the wrap up to the session. I have more slides about what we do and so on, but I don't want this to fall into some salesy session. I actually want this to be helpful for the founders that are listening live or later on when we post this on our YouTube channel. So I'll wrap it up here in terms of what we do, what is important, why I'm sharing this example. And I'm gonna jump into the one comment we have on the chat. Thank you for that one, who is saying that customer revenue cohorts are also performance I like to look at. 100%. It's tied to what we were saying before here, all the different metrics and how the different customers contribute to that revenue, avoiding any customer concentration. And if you have a customer concentration, make sure you're working with an advisor or a banker that can offset that risk and that can explain why it's not as dangerous for the that's acquiring it. So thank you for that comment. We can never emphasize how important customer revenue cohorts are. And we've seen how the market is behaving as a whole. We've seen the different trends, what buyers are looking for, and the key metrics that you need to keep in mind when you're building your company so that you maximize an exit down the road. We've seen the importance of process. This is, in fact, an overview of the type of processes that we run from the very beginning when we help founders prepare to sell, understanding not just the market and the underlying trends and the acquirers and so on, but also the needs of the company, of the founder, cleaning up their financials and all of that, all the way towards actually closing the transaction. And if anyone wants to continue this conversation, have any questions for me that they're too shy to share on the chat, please feel free to reach out. I'm always happy to chat. I had scheduled this session for an hour, and in my mind, it was always going to be between half an hour and 45 minutes. So I would say we're on time, and hopefully, I'm gifting you back some of that precious gift of time. But given that we are very much on time, I'm going to leave the mic open still, give it a couple of minutes in case anyone has any questions that they would like to share or any other comments. Perhaps I'll be here for a while. Not a while, maybe a couple of more minutes, like we were saying. Because it will be a delay. I hope this was helpful. Again, it was more high level. At the end, what's important is understanding what's driving the market and what acquirers are looking for and what you can do to make the most out of your exit. Okay, I guess that's it. Well then, I think this is a webinar where I've spoken more by myself ever, a monologue. But again, hope it was useful. And we will be sharing the presentation to everyone that was registered but that couldn't make it. And again, if you want to chat about this, share insights, challenge anything that I've said, please do. And here's how you can get in touch with me. Thank you.